Special guest in place, Treasury Secretary Steven Mnuchin. Mr. Secretary, thank you very much for coming on board today in a very busy day. Appreciate you being here, sir. Thank you.
Great. It's great to be with you.
Volatility. Got to talk about that right from the get-go. I got a theory that part of this volatility is the result of all this computer trading algorithms. Are you with me on this?
I am completely. I think that with the advent of computerized trading, which has such a big part of the market now, combined with the Volcker rule, where you can't have market makers commit capital, you just have much bigger moves in both directions. And I think clearly you have a situation here where the market has overreacted to the Fed's comments, and you see program trading taking over.
Is there anything you can do about it, Mr. Secretary?
Well, at FSOC, this is something we're going to look at. I don't want to prejudge any decision, but this is one of the things we're going to look at activities-based risks.
Did the Fed do the right thing yesterday? One interest rate hike now, maybe two next year?
Well, let me say, as Treasury Secretary, I think it wouldn't be appropriate for me to comment on if they did the right thing or they didn't. But let me just comment what I think they did do. So the market was clearly expecting them to have a rate hike that was priced into the bond market and into the Fed funds market. I think that the market was disappointed in the chairman's comments. But I would say if you look at the specifics, you can't just look at the headline, which was 2 more rate hikes. You have to look at actually the 17 dots on the dot plot. So each one of the governors and the people on the committee put their views. If you look at this, the high end of the range came down significantly, and there's still a pretty wide dispersion. So there's clearly people on the committee who think they don't need to raise rates much here. And I think, you got to put this in perspective. We had 5% and 6% interest rates. The Fed has said they're close to done. He said they're data dependent. So I think the market's overreacted, and equities, U.S. equities, are tremendous value.
The Fed predicted 2.3% economic growth for the year 2019. They lowered their projection a little. How does that square with your projection for next year?
Well, I think, as you know, coming into this year, the Fed's projections and the blue chip were substantially below ours. We commented that we thought we'd be at 3% or higher this year. People were skeptical about that. The Fed's projections were lower. And we believe that we're going to deliver this year 3% or higher. I'm still optimistic that next year we can do 3% as well. But I would focus on the Fed's projection on inflation, which is really the more important issue for the markets, that the Fed lowered their expectation for inflation, which is a good thing. We've seen inflation come down. We've seen the oil markets come down. So I think you're looking at a very attractive investment market for the next year.
I'm kind of reading between the lines, and it seems like you're suggesting that further rate increases next year will not be necessary.
Well, I think that the Fed is data dependent, so I'm not going to speculate what they're going to do and what they're not going to do. If you look at the center of the dot plots, it says two more rate hikes. But again, there's a pretty big dispersion there. And I think Chairman Powell made it perfectly clear yesterday that he's going to be data dependent. So if we have low inflation, continue to have low inflation, given where we are, I think you're going to see a different situation.
So do you think the market reaction was overblown to the Fed's move yesterday?
I think the market reaction is completely overblown. And, if you look at the U.S. growth versus Europe versus the rest of the world, the U.S. is still going to grow significantly higher. You look at a slowdown in China and the emerging markets. So we continue to see, when I speak to businesses, I still see a tremendous investment dollars coming into the U.S., people investing in the U.S. And I also think you're going to see a bunch of rebalancing. The bond markets have rallied significantly. You look at where the 10-year is. I think you're going to see rebalancing out of bonds into equities at these levels.
Okay. The market now is down over 300 points. When you and I started talking, we were down 270 on the Dow Industrials. Now we're down 310, 311. And you said that the market's reaction to the Fed is overblown. Seems like maybe you are pushing it further down.
Well, I don't think that's the case, but the markets will be the markets. I'm just giving you my perspective on this. One other issue that the market seems very focused on that I would comment on is this issue of the Fed's downsizing of the portfolio. And I would just comment, although this is clearly the Fed's decision, we are in close contact with the Fed on our issuance and what they're doing. And again, this isn't a downsizing. They're just reinvesting at a lower rate. And I would just comment, I think a lot of people were critical, as were we, on the size of the Fed balance sheet. The good thing about them downsizing the balance sheet now is it gives them capacity if they need to do something later in the year or next year. And I think we're comfortable with the supply and don't see that as really as big of an issue as the market seems to be focused on.
Earlier this morning, Rod Rosenstein, Justice Department, stood up and publicly indicted 2 Chinese nationals for spying and stealing our commercial data. He actually named them and he said, we know who is sitting at the keyboard stealing our data. If you couple that development with the 3rd Canadian detained yesterday, does this complicate and make more difficult a deal with China on trade?
I don't think so, not at all. I mean, we've been clear from day one that cyber is an issue. We've had discussions with them. This was discussed when we were there. I think you know that we've said this isn't about buying soybeans and buying energy, although they clearly will buy a lot more of both. This is really about protecting U.S. technology. So the DOJ action is separate from the trade discussions, just as the Huawei discussion is separate. But, as the administration, we are clearly very focused on making sure that we protect American technology. And this will be a separate dialogue, but something that's important to resolve.
I think, though, that China links the 2 or the 3. They're not separating it out at all. They regard the Canadians as hostages. I don't know what they're saying about the indictment of the spies, but they are putting it all together here.
Well, I'm not going to comment on the situation with the Canadians, but I will comment in our trade discussions. And as you know, we've been having ongoing trade discussions by phone over the last few weeks. We are moving forward with those discussions and trying to reach an agreement that was the agreement between the 2 presidents, which covers a whole range of issues. We've talked about very significant structural issues. We have not discussed this specific cyber issue with them, but cyber has definitely been on the list. So I'm cautiously optimistic we'll continue to be able to work through these issues.
Can I sum it up like this? You see next year as low inflation, maybe 3% growth, and maybe the Fed will not be raising rates next year at all. Can I summarize our discussion like that, Mr. Secretary?
I think that's right. And again, I would just emphasize U.S. growth a lot stronger than the rest of the world. U.S. business activity continue to see pickup as a result of the Tax Act. We think we're going to continue to see a lot of capital investment. So, even the Fed said yesterday they see strong economic signs.
Mr. Secretary, Steven Mnuchin, Treasury Secretary, thanks for joining us, sir. We do appreciate it. Thank you very much.
Yeah. Great to be with you.
Thank you, sir.